Welcome to vTalkInsight, Market Drivers Daily for January 13th, 2026. Geopolitics, politics, and safe haven flows are colliding today, from unrest in Iran and uncertainty in Venezuela to criminal probes into the Fed chair and record moves in gold and silver. Let us unpack what this evolving backdrop could mean for cross-asset risk and opportunity. Global geopolitics are again at the center of market discussions, with the energy map, alliance structures, and currency perceptions all in play. The most acute pressure point remains Iran, where nationwide protests now cut across social classes and regions, and economic stress is severe, with runaway prices, expensive food, high youth unemployment, and a currency that has lost almost all of its value. Security forces remain cohesive and repressive, but the breadth of unrest raises the risk of serious regime instability. In parallel, Venezuela has seen formal political change without a real transfer of power, and U.S. intervention has not delivered quick stability. Governance remains fragile, criminal networks are entrenched, and that leave a wide range of outcomes for both domestic politics and foreign energy investment. Energy markets sit at the intersection of these flashpoints. Despite intense headlines, the near-term global oil balance still looks comfortable, with an estimated surplus close to 1.9 million barrels a day, which helps cap immediate upside in prices. That said, Iran is a far larger producer than Venezuela, and multiple insights highlight that any meaningful disruption there would matter much more for global supply than incremental Venezuelan barrels. The biggest tail risk remains a closure or serious disruption at the Strait of Hormuz. Given current positioning and limited preparedness, that sort of event could deliver a severe shock to oil markets, with shipping insurance costs spiking and volatility rippling across broader risk assets. Venezuela, by contrast, has seen exports slide from several 100,000 barrels a day to closer to 300,000, and major companies describe the country as effectively uninvestable under current legal and security conditions, even though some operators see scope for moderate production gains over the next few years. Beyond the Middle East and Latin America, the Arctic is becoming another arena for tension. The United States is pushing for greater control over Greenland, while the United Kingdom and Germany are advancing plans for a stronger NATO presence there, and European defense spending expectations are firming as a result. At the same time, Germany is negotiating major defense and technology deals with India, including an $8 billion submarine partnership, and the European Union is working toward a large free trade area with Mercosur. These moves are part of a broader effort to diversify away from over-reliance on China and the United States. Supply chains are adjusting in other sectors as well. The United States is convening G7 partners on rare earth security after new export restrictions from China, while firms such as GE Healthcare are regionalizing production to reduce geopolitical exposure in critical industries like medical equipment. For markets, these tensions translate into a series of differentiated risk premia. The U.S. dollar is already seen carrying an additional risk premium of around 3% as investors revive hedging strategies, with scenarios where U.S. strike on Iran could weaken the currency, while a regime shift there without American involvement could have the opposite effect. Gold and silver are drawing persistent demand as hedges against both geopolitical shocks and concerns about fiat currencies. Some see further upside from here, but crowded positioning raises the risk of sharp, temporary reversals if geopolitical news flow stabilizes. Importantly, oil prices themselves have remained relatively contained despite escalating protests in Iran and uncertainty around U.S. responses, suggesting markets still demand concrete proof of physical disruption before repricing the entire complex. In summary, we have an oversupplied base case in oil, but rising tail risks in Iran, Venezuela, and the Arctic, plus a steady drift toward more fragmented supply chains. The key watch points now are any credible threat to the Strait of Hormuz, concrete frameworks for large-scale Venezuelan investment, and NATO decisions on Greenland, which together will shape how much additional geopolitical premium markets demand before turning their focus back toward domestic policy risks. Policy risk is increasingly centered on the credibility and independence of the Federal Reserve, rather than just the path of interest rates. The Department of Justice has issued grand jury subpoenas to the Fed and its chair, with the investigation widely viewed as politically driven and directly linked to frustration over high interest rates. There is also active discussion about whether these legal actions could be used as grounds to try to remove the chair, which would likely trigger protracted court battles. On top of that, Supreme Court arguments on presidential authority to dismiss Fed governors are looming, and political figures are threatening to block new appointments in the Senate, creating uncertainty around future leadership and the composition of the policy committee. Former Fed chairs, Treasury secretaries, and other senior figures have issued unusually blunt warnings that politicizing the central bank could undermine its effectiveness and erode institutional trust. Some explicitly compare the risk to an emerging market-style environment, where political leaders dominate monetary policy and inflation expectations become unanchored. One scenario described across these views is that a clear erosion of Fed independence would likely steepen the U.S. yield curve, pushing long-dated yields higher, weakening the dollar, and raising the risk premium foreign investors demand to hold U.S. assets. There is also concern that repeated legal attacks and public criticism could endanger the dollar's status as the primary reserve currency over time, especially if investors conclude that inflation will be tolerated in exchange for short-term political gain. So far, as we noted late last week, bond markets have not fully priced this worst case, but the direction of travel in the commentary is clearly toward higher perceived policy risk around the Fed. Policy risk is not just about the central bank. The White House has floated a one-year cap on credit card interest rates at 10%, roughly a third of prevailing levels for many borrowers, without a clear legislative path. These kinds of proposals, along with ideas to limit buybacks or dividends, raise questions about how far the administration is willing to use executive authority to reshape private credit markets and corporate finance. Market participants warn that over-regulating formal credit channels could push lending into less supervised parts of the system or fuel asset bubbles elsewhere, particularly if investors chase yield in more opaque structures. Senator Warren has separately highlighted the risks of allowing crypto assets in retirement plans via executive action, arguing that such moves could expose pensions to large price swings and regulatory blind spots. Even operational decisions, such as cutting training time for immigration enforcement agents to just over 6 weeks, are raising concerns about governance quality and longer-term social stability. Despite the noisy backdrop, some observers argue that many of these policy initiatives remain more symbolic than transformational so far. Recent executive orders and fee cap announcements are seen as headline-heavy but difficult to implement at scale, and bond markets have reacted only modestly to the Fed-related legal news. At the same time, investors are still focused on supportive elements such as fiscal expansion, tax cuts, and the prospect of future rate reductions, which has kept demand for new bond issues strong, including in emerging markets. This mix leaves a tension between a relatively benign base case and a set of more adverse paths, one where Fed independence erodes, long-end yields move materially higher, and the dollar weakens further, and another where aggressive regulation distorts credit allocation and ultimately undermines growth. Key markers to watch now include developments in the DOJ investigation, Supreme Court decisions on Fed governance and tariffs, the treatment of new Fed nominees in the Senate, and whether proposals like credit card rate caps advance beyond rhetoric. How those evolve will help determine whether policy remains a modest background risk or becomes a primary driver of asset pricing and, as we will discuss next, of volatility itself. All of this is feeding into a more unstable volatility backdrop, even if the full adjustment in prices may still be ahead. News of criminal probes and subpoenas aimed at the Fed chair has already hit sentiment in equity futures, with notable declines reported in Dow-linked contracts and risk-off moves across S&P and NASDAQ futures. Other political and legal headlines are also adding to uncertainty. Grand jury investigations involving senior political figures, the risk that charges do not lead to convictions, and the approach of Supreme Court rulings on tariffs and presidential powers all contribute to a thicker tale in possible market outcomes. High forward valuations in U.S. equities mean that any policy shock can translate quickly into sharper price swings, as investors are less willing to look through short-term noise when multiples are already stretched. Safe haven behavior is most visible in precious metals. Gold has pushed to record territory, while silver is registering another month of double-digit gains, with some measures pointing to rises in the high teens. These moves reflect a combination of factors: anxiety over Fed independence, fears of broader geopolitical escalation in places like Iran, and skepticism about the reliability of fiat currencies and alternative hedges such as Bitcoin. Mining equities are benefiting from the upswing, and in some cases copper is joining gold at all-time highs, helped by concerns about supply and strong demand linked to the energy transition and infrastructure. Looking ahead, some see room for gold prices to climb further from here, but the consensus that metals are a favored hedge means positioning is crowded, which could amplify short-lived pullbacks if the news flow becomes less negative. The volatility story is not confined to equities and metals. The dollar is weakening against major peers, and investors estimate an additional risk premium of roughly 3 percentage points as they hedge against policy and geopolitical surprises. Scenarios around Iran again matter for currencies. Views suggest a U.S. military intervention would likely weigh on the dollar, whereas a regime transition without direct American involvement might support it. The yen has also shown notable swings on domestic political uncertainty, underscoring how sensitive FX markets are to changes in perceived institutional stability. In U.S. rates, front-end yields have edged lower while longer-dated yields have drifted higher, and some expect the 30-year bond could ultimately trade above 5% if political uncertainty and unconventional policy proposals persist. At the same time, several observers note that implied volatilities in many markets remain surprisingly subdued relative to the scale of risks being discussed. That disconnect between fundamental risk and pricing leaves markets exposed to abrupt repricing if catalysts hit. Potential triggers include any clear move to sideline the Fed chair, an adverse ruling on Fed governance, sudden escalation in Iran that threatens oil flows, or a sharp shift in the tariff regime tied to trade with Iran or other hotspots. Each of those paths could simultaneously jar equities, widen credit spreads, steepen the yield curve, and extend a rally in safe havens, moving the volatility regime from sporadic spikes to something more persistent. For now, it is notable that oil and U.S. Treasuries have shown relatively muted reactions to both geopolitical and policy news, and that risk appetite has been strong enough to absorb large bond issuance, suggesting a still constructive baseline. The tension between that resilience and the evident fragility around headlines is the defining feature of the current environment. Monitoring changes in equity implied volatility, safe haven demand in gold and silver, and the behavior of the dollar and long-term yields will be central to judging whether we remain in a bumpier version of the existing regime or transition into a more turbulent one. To wrap up, geopolitical fault lines from Iran to Venezuela and Greenland are reshaping energy risk and defense spending, while Washington's approach to the Federal Reserve and credit markets is raising questions about policy reliability and the long-term value of the dollar. These forces are already visible in weaker equity futures, record highs in gold and silver, and shifting risk premia in FX and rates. The practical takeaway is that markets are juggling an oversupplied but fragile oil backdrop, rising institutional risk around the Fed, and a volatility regime that can change quickly as legal and geopolitical headlines break. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.